Hey guys, welcome back. And as you all know, this channel was made so that you can have a better trading life. So what I'm going to talk to you about today is essentially four things, which is what Deriv does not want you to know, if you're supposed to trade against or for a spike, and then I'm going to give you a strategy that can help you trade for either direction. And also I'm going to talk to you about 4 EAs or 4 trading robots that will give you rest when it comes to trading boom and crash index. And lastly, I'm going to touch on, but I'm not going to spend too much time on this. I'm going to tell you how to actually get phone notifications about probably an event. Say your trade is now in profit and you want to know if your trade is now in profit, and you are not necessarily close to your laptop, but you want to know through your phone. You can actually receive notifications either by text or by an app notification from MetaTrader. Okay, so without wasting much of your time, let's just get into the video. Now, you could watch the full video for the best results, but you can skip to your desired part, because not everyone wants to learn the strategy, not everyone wants to know about notifications. So because this video is a bit lengthy, you would want to skip to the part that you desire to watch. Okay, so let's start. Now, what is deriv.com? Before we even talk about what they don't want you to know. So deriv.com is a platform where people actually trade both currencies and binary options. Now, what these guys have done over the years is they've tried to basically, based on the demand that has been there for binary options, they've tried to create new kinds of trading assets or trading symbols. And these are known as the synthetic indices. Now, the synthetic indices are not actually a real market type asset. Please bear with me, because I know, I understand some of you trade synthetic indices and would be very, very much offended to know, or to even be given the idea that these assets are actually not real. They are not real in the sense that they actually mimic market direction. Okay, they actually mimic market performance. So they themselves do not exist unless created. Okay, so you understand that boom and crash index were not always there, but they were actually formulated just recently. Okay, so they only used to have volatility indices, volatility 10 and volatility 50, right? Those were the first two. Correct me if I'm wrong, but those were the first two. And then they developed further into volatility 25, volatility 75, volatility 100. And then they added the volatility 100 1S and so forth. So these synthetic indices are actually generated by an algorithm. Okay, and these algorithms have been made by software developers. In fact, not software developers, but programmers. Okay, so you understand that most of these programmers that are actually hired by deriv.com tend to have a background in either just basic programming or a background in mathematics, right? So what they do is they try to create assets that are statistically impossible for you to beat, or not necessarily impossible, but over time they've got a negative expected return, meaning to say you have to be losing money in the long run. That is the reason why you see that most of the times you make money, and then over time you're actually losing the money, because these indices have been programmed in that very way. And the algorithms are not actually independent. They change from time to time. So basically what they do is actually the programmers, when the system is being beat, or when people actually find out how to beat a system, they actually try to change the code so that at least the program can run and still generate profits for deriv.com. Okay, so that's one thing you need to know. And the other thing that you basically need to know, you know what, I'm talking about these things not from a spectator perspective. Okay, I received an offer from deriv.com, so this is one of the reasons why I'm talking about this. I received an offer from Deriv, and they actually wanted me to work for them to try to help keep them profitable some time ago. Okay, and they stated implicitly in their email that what they want is a person who can continue to help them be profitable by actually monitoring the algorithms. Okay, so from time to time, as the liquidity provider, Deriv will make adjustments that benefit them as their end goal. I mean, is to be profitable. So the end goal is to be profitable. So they want something that will help them in the long run. So you understand this as we go through the video, but I wanted to tell this to you. And so effectively, deriv.com is like a betting house, okay? When it comes to synthetic indices. They can choose at any point in time. It's written in their disclaimers and everything. It's written in there that they reserve the right to actually stop the trading of a certain asset at any point in time. They reserve the right to close your account at any time. They reserve a lot of rights. So from time to time, they will make adjustments that just benefit the end. So now let's talk about boom and crash indices and how this has actually revolutionized the trading arena for deriv.com. So the reason why boom and crash indices attract so many people is they promise a good return on spike, and that's very, very instantaneous, or they actually promise a good return as well if you're trading against the spike, but with a higher lot size. Okay, so a lot of people, you know, because they really want to get money pretty fast, they tend to switch to boom and crash indices. Now, let me tell you what you already know, but in a different way. And I hope this will make you see the market in a different light. Okay, so with boom and crash indices, if you're trading against the spike, trade against the spike. If you're trading for the spike, trade for the spike. Don't try to trade on both sides. Okay, in the long run, you lose money. I will explain this later, but let me talk about trading against the spike at the moment. Now, the first thing is that if you're trading against the spike, there is what is known as slippage. Okay, so slippage occurs when a spike occurs, and slippage is when the market actually gaps. What do we mean by a market gap or a market jump? So a market gap or a market jump is an instantaneous change in price such that the market will not be able to execute any other price in between that gap except for the new price that is there. So take, for example, you go to the shop, right? And you have $5 in your pocket. And you want to buy a bag of potatoes, right? Now, you're at the shop, you're standing at the shop, and immediately the person who is on the counter who's supposed to serve you, before you hand him the money, they receive a phone call to say the bag of potatoes has just changed in price. It's now $7, right? That's an instantaneous call that you have just received. So before you even hand them the money, when you actually do give them the money, they're going to have to make changes to say the price is not $5, but the price is now $7. Okay, so that is the one reason that slippage will actually kill you, because the new exercise price, or the new price at which the contract is being exercised at, is actually different from the previous price. So that's $2 gap. You will not buy the potatoes at $6. You will not buy the potatoes at $6.50. You would have to buy them at $7. So same thing happens with spikes on this particular case. When the market spikes, what it means is that if you wanted to execute a contract anywhere in between the gap, or anywhere in between the spike candle, you're actually going to execute it at the end of the spike candle, right? So you can go and read about slippage, you can go and read about market gaps, but this is a basic explanation that I've just given to you. And so with this particular strategy where you're trading against the spikes, you will actually have the broker accumulate volumes while you are selling boom, right? So you're selling boom, they're actually accumulating volume. And then once they have realized they've reached the volume target that they want, they will make it spike. And when they make it spike, if you do have a stop loss, that stop loss will not be respected if the stop loss falls between the previous price and the price with which the spike is going to land on. Okay, so that is one reason. And then, so because of the long time taken to build your account, you will most certainly trade emotionally in the long run. Okay, so imagine holding a trade for, say, 5 hours, and then it booms it spikes in the next probably 10 minutes, and you're in loss, and you've been holding a good profit amount. So there's a lot of emotional trading involved with trading against spikes. However, I'm going to give you a simple solution, which is going to be analyzing higher timeframes with the strategy that I'm going to give you. And you also need to use a small lot if you're going to trade against the spike. Please do not listen to anyone who tells you to use a big lot when you're trading against the spike. It is never ideal, never has been, never will be. Okay, so that only works if your account is big, in which case also it becomes a small lot. Okay, and so I will share the strategy that I'm going to share with you pretty soon about how to actually trade against the spikes. But I just don't recommend it for newbies. I recommend it for people who actually have been trading for quite a while. Okay, so the next thing is I'm going to talk about spikes. Now, a lot of people have a lot of strategies on trading spikes, whether it's buying boom 1000 or selling crash 1000 or whatever the case may be. A lot of people have got different types of approaches. Now, what you need to do as a trader is you choose one approach. Okay, if you're going to use lines of support and resistance, use those. Probably use other tools as well as a measure of confluence. Or if those things do agree at a certain point, then you confirm your trade and say, I'm going to enter now because I've seen 1, 2, 3 confirmations. Otherwise, do not use too many strategies. You end up confusing yourself. Just use probably 2 or 3 tools. So I'm going to show you a strategy that captures spikes very, very easily. But I'll also share with you some EAs that I've developed as well. So I've developed some EAs for boom. I've developed some EAs for crash as well. So you will learn how to capture the spike. Okay, so you're trading for the spike and not against the spike. And if the spike occurs after you're taken out, say you are buying, and then this is boom 1000 and you're buying, and then the market goes down and hits your stop loss, and then after hitting your stop loss, it spikes. Don't try to follow the spike, okay? Just remain calm, trust your analysis for the next time, see where you went wrong, and then make adjustments as you go. Don't try to trade emotionally or try to follow the spike, okay? So let's move on to the next thing. Let me now share with you the strategy that I have developed. Now, I'm going to put a disclaimer. This strategy is actually a derivative of another strategy, okay? It is not necessarily an original strategy, so I should say, but I actually made a few adjustments and combined different theories. I combined the market maker theory, the quarters theory. I also combined my knowledge of the derivative platform and optimizations to actually come up with a strategy that captures both the spikes and anti-spikes. Okay, so this strategy will help you trade with a peace of mind. Let's look into the strategy. So let me just go to my MetaTrader. All right, let me go to my MetaTrader. What I will do for now is I will minimize this here. Then I'll go to boom 1000. Okay. Zoom in. Okay, so let me just create a new chart here. Let me just create a new chart for boom 1000. So your chart usually comes like this. And for you to remove the grid or these square boxes, you press on Control and click on G. So your chart becomes a little bit clearer. And then you right click on your chart, go to where it says properties. On properties, what you need to do now is you need to go to the show, and on show you click show ask price line, and you also show period separators. Okay, so what we want to see is the gap or the separator between days. So click on OK. So now we have the period separators, and I want these chart inputs here. I want these chart inputs. I want to have exponential moving averages, right? I'm going to use EMA 6, EMA 23, EMA 92, EMA 365, EMA 1460. Okay, so let's go to the chart, and on indicators, you go to moving average, you put moving average 6, make it red or crimson. Then let's go to moving average again, moving average 23. I'll explain in a moment why I'm using these moving averages, okay? Moving average 23, I'll make that yellow. Moving average 92, I will make that aqua or water. And then moving average 365, I will make that blue. And then the last one, which is the moving average 1460, I'll make that brown. Now, the question that you ask after seeing these moving averages is probably, why did I choose these particular numbers? Why did I choose 6, 23, 92, 365, and all of that? So the reason why I chose specifically this EMA here, EMA 365, with the market maker method or the market maker theory, they actually use the EMA 200 as the baseline EMA. And the reason for this is the number of trading days that are actually active in a particular month is 200. I won't really say much about this because I'm pressed of time, but because Deriv trades every single day of the month and 24/7, I used the EMA 365 because it will become a better measure of the support or the resistance of the daily chart. Okay, so EMA 365 becomes a very, very good measure for the daily chart. And if you divide that by 4, which is now taking into account the quarters theory, you realize that you need EMA 92, which is 365 divided by 4. You need EMA 23, which is 92 divided by 4, and then 23 divided by 4. It's about 3 point something, which is close to 6, which is 5 point something, sorry, which is close to 6. So at the end of the day, these are the EMAs that you need. And then 365 multiplied by 4 will give you 1460. Now, if you are to go to any chart on any synthetic index and put these EMAs, you will see that they work perfectly. Okay, so let's actually move to the chart so that you can actually see. Let me clear these drawings, clear all drawings, and let me show you this. This is Boom 1000 index, okay, and we're actually on the H1 chart. I'm going to switch from the H1 to the M15. As you can see, the EMA becomes a measure of support or resistance, and it's actually going to be very easy for you to tell where the spike is going to occur. Let me actually zoom out. Let me actually zoom out a bit. Zoom out. So you actually see as well that it will be very, very easy for you to trade these spikes and against these spikes later on. Okay, so how do you save the template? So what you do if you've got these EMAs now, clear all drawings. If you now have these EMAs in place, and you probably want to remove this particular chart, probably you want to go to another chart, and then maybe when you come back to MetaTrader, you want this chart to show. What you do is you right click on the chart, click on templates, click on save template, and we are going to save this as Boom video so that you remember that this is what we were using in the video. And also, I've received some questions before about why MetaTrader 5, when you actually maybe draw your analysis, you draw some lines and everything, then you close your MetaTrader 5. When you come back, those lines are gone. Every time you draw trend lines and you analyze and you want to come back and see your analysis in place, save that template. The same way we saved this Boom video template, save your template like that. When you come back, just reload your template like this. So when you want to reload your template, what you do is you go to a chart that does not actually have the template, and then what you do is you right click on the chart and you go to templates, click on boom video, and voila, this is the template. Okay, so as you can see, this particular template or this particular strategy can tell you exactly when we expect a particular boom or spike or crash to occur. Like in this case, there was the first level spike here. We're going to talk about that as well later on. First level spike here, and then the market pullback. Let me draw. There's my drawing two. Market pulls back. Then after market pulls back here, it spikes on this EMA, right? They call this the ID 50. When the market actually spikes on the 50 EMA, but in our case, it's called the ID 92 because we're using the 92 EMA, not the 50 EMA, okay? And then the market comes back again and then bounces the third time, and this will become your level 3. So market usually moves in 3 levels, so that will be level 1, level 2, level 3. And when the 3 levels are complete, the market will create a peak formation. And in our case, the moving average 1460 becomes where the market actually turns, then forms this lovely W here, which is a double bottom, and then it starts to go up. And that would be your level 1. And then the pullback to the 92 EMA, that would be the level 2. Then after that, we have this here, and then that would be level 3. So basically, the market will repeat these cycles day in, day out. And I will try to come back again with another video, probably explaining all of this in more detail. However, in the meantime, because we cannot possibly exhaust everything, because this is a strategy with theories, with reasons why this is actually happening, this level 1, level 2, level 3 stuff. So if you're going to look at any chart, probably you're looking at V75, you're looking at V100, you're looking at step index, you're looking at jump, you're looking whatever asset you're going to be trading on this particular platform, you can use this strategy. You can adapt it. You can change a little bit of you can check your entries. You see the historical behavior. Of course, historical behavior does not necessarily imply that that's the future behavior, but this is just one of the ways you can help yourself. Okay, now let me probably say a little bit about these particular moves that the market does. Okay, now let me clear these drawings. Clear all drawings. I'm going to talk about this method for crash 1000, and then I'm going to move into boom 1000, so you can actually see these EMAs in action. Okay, now what usually happens is this: when the EMAs are spaced out, and you have the EMA spaced out like this, and you see a peak formation, probably a double top. Usually, when you see a double top that looks like this, and the M goes below the other side of the M goes below the previous side, that's a good sign, okay? I've seen a lot of people, when they see an M on Crash 1000, they actually fail to identify whether it's a proper M or it's not a proper M. If the M is like this, it is not an M. Market will most likely continue going up, okay? So when you see the EMA spaced out and you see the 6 EMA, the 23, the 92, and the 365 spaced out like this, what it means, the market is most likely to be going to go down pretty soon. So if the market is going to go down, clear all drawings. If the market is likely to be going down, what you need to check out for is intersections of these EMAs. So the first confirmation that we have is the 6 and the 23 EMA intersecting. If these two EMAs intersect and then they actually get 6 and 23, they get into the 92 EMA. If they get into the 92 EMA, that is the confirmation for the first level. So the first level is the 6 and 23, and then the 6 and 23 moving into the 92. So this will be your level 1. And we said the market moves in 3 levels. So you measure the level 1 from the point of intersection there to this particular point here. Then after this, the market will most probably pull back and hit the 92 EMA. So when it hits the 92 EMA, get ready to sell, right? So this is where you're putting your sell trade. So you put your sell trade right around here, and then the market goes down for level 2. Now, after the market goes down for level 2 and the 92 and 365 cross, if these two cross, is what is known as a peak lock. Okay, so what it means is that the market will come back and it will either bounce on the 92 or the 365. If they are too close together, it will probably bounce on the 92. But when the market bounces on the 92 like this, it then comes down to form level 3. Now, after level 3, the market, what it will do is it will reverse. And if the market hits or reaches level 3 before it crosses this bigger EMA, this 1460 EMA, it will not continue going the direction that it was going. It's a complete reversal. So it will go up. And the same way we're counting in that other direction, if these two intersect and then they go and get into the 92, that's level 1. Level 1. And then if the market comes back down and hits on the 92, that's level 2. And if the market comes back again and hits on this particular EMA here and goes up again, that will be level 3. And just by this illustration, I have taught you how to trade both the spike and against the spike. Okay, so you need to find a peak formation here, PF, right? You need to find a peak formation. After finding a peak formation, you can now trade going in against the spike. Unfortunately, I don't want you to trade against the spike. I want you to trade for the spike because you hold the trade for less time and get more money, less stress. And after this, you see level 1 occurring here and then hitting in this place. There was no level 2 that was clear, but because the market actually did have a peak lock here, this becomes our level 3. And this becomes level 1 and 2 combined. And when the market actually goes down like this and goes below this big time EMA, which is the 1460 EMA, we do not expect a reversal. In fact, we actually expect what is known as a peak reset. So the market is going back up and it's going to bounce on this big EMA, which is the 1460, and it's going down. So this is what we're expecting for the crash 1000 index. Notice that I am actually looking at the 1 minute chart because it is easier to understand. However, if you want to really get proper entries that will probably make you trade for a longer time frame, you need to check confirmations on higher time frames. That is a basic rule of the thumb when it comes to trading. Okay, so this is for what? For crash 1000. Okay, so let me clear this drawing. Please, if you didn't understand, try to watch this again until you capture some detail. I'm going to post a longer video another time, another day, for just specifically this. Okay, clear all drawings. Now let's go to boom 1000, and I'm going to go to M1 as well, so that you can see how we can spot where the market is actually going to boom. And I'm going to first go with the boom side, and then we go to the side where we're actually trading against the spike, right? So there we go. Now with boom 1000, because this thing actually, right, I think this is going to be a very easy one, right? Because with this one, it's very, very, I would say, volatile. What you need to do is you need to first create a confirmation. Let's look at this. Let's look at this. Let's say we have the first confirmation that we're talking about, which is the intersection between the 6 and the 23. And then the 6 and the 23, they intersect with the, what do you call this? The 92. Usually, the market will go and hit the 365 EMA. If it hits the 365 EMA and does not exceed the 365 EMA, 90% of the time, the market is actually coming back. So here you see the market went back, and it went back 3 levels as well. 1, 2, 3. And after going down 3 levels, it went back up, did not exceed this by a big margin, went back down 1, 2, 3 levels again. Third time around now, the market went into the EMA here, went above, came back down, and bounced off of this 92 EMA, which is now the confirmation that we needed. And also, if you look at it from a bigger perspective, this is a shoulder here, this is a head, and this is another shoulder. So this was just a head and shoulders pattern. And once you spot the head and shoulders pattern, you know that this market is about to go up. So you can buy here. And then the 92 EMA provides you with the entry. And then the market goes up. And as you can see, the market is actually just coming back and bouncing off of these EMAs. So it goes up, bounces off this EMA, goes up, bounces off this EMA, goes up, bounces off this EMA. And this happens like, clear my drawings. So this happens like every time. And The good thing is if you miss the EMA on the first bounce on the first EMA, you get the next bounce. Okay. So if you were trading just this yellow EMA here, you would have just been making money here by these bounces. Then when you miss the yellow EMA, what you would do is you set the next trade on the what? On this particular EMA. Either you put the stop loss there or you put the next trade there. So what will happen majority of the time is that the market will come back down. If it does not bounce on this 92 EMA, it will bounce on the 365 EMA. So this is for Boom 1000. And if you're going to trade against the spike, let's clear this. The only reason why I'm trying to move as fast as I can is because I don't want to keep you in this video. If you feel like you need to skip the video, you can skip it and go probably to an EA that I've customized with the same settings. Okay. So if you're going to trade against the spike, you will have to wait for these confirmations. Okay. So you wait for the first confirmation and the second confirmation where the market comes into this. So this will become your level 1. And then the market comes back up, it bounces off the 92 EMA, and that will become your level 2. And the market comes back up, level 3. Then you have your nice W formation there, and the market goes up. Now, if the market finishes 3 levels before the peak lock, or before the cross of these two, it becomes, the market actually comes back down. In our case here, the market goes up. This is actually level 1, which has got three spikes, and then market comes back down to create the ID 92. It goes up. So basically, I think you get the point. What I'm going to do now is I'm going to show you how I've created an EA or a robot that is going to help you. You can actually trade while you're not looking at the chart with this robot, and which is like basically that's the basic idea. But I've put in settings that will blow your mind. Okay, so let me just clear this, clear all drawings, and this is what I'm going to do. I'm going to demonstrate these EAs. I'm going to demonstrate these EAs. So for the Boom 1000 EA, I actually just optimize it so that we can actually just trade 4 days. And these are the profitable days for Boom 1000 for this particular EA. It doesn't necessarily mean if you are trading on Wednesday, you are losing money. No, but if you're trading on Wednesday using this strategy that I gave to you, it is profitable, but less profitable. Okay, so I optimized it for profit. And as you can see, my EMA is here. These are my confirmations and stuff. So don't worry about this. This is just the code. What I want you to know is when you run your EA on the MetaTrader platform here, what it will do, let me just test the results for settings. So we want to check how the different EAs that I've created perform versus the asset, right, or the symbol. In our case, we want to check Boom 1000 index. So I'm going to use the Boom 1000 Assassin EA. If you want the EA, just check the description. The details will be there in the description. So Boom 1000 Assassin EA, I'm going to test it from 1 July 2021 to today's date, which is the 17th of August. Now, remember, the only reason why I'm doing this test for July to August is because I'm using the M1 chart. So for me to download the 1 minute time frame history for the whole year is going to be very, very burdensome. Okay, so let me just do this, and then I'm going to enable this visual mode. So what the EA does, the Boom 1000 Assassin EA, what it does is that it sets the take profit, it sets a stop loss, it sets what is known as a trailing stop. So what it means is that if the moment your trade is in profit, the stop loss will start to move so that at least you minimize your chances of actually losing money. And at the same time, when you are in more profit, when the market actually comes back, it protects your EA from losing money. So you can trade peacefully. And I'm going to test this with a lot size of 0.2 over $100 account. So this is by far the most competitive test you've ever seen on any EA, because most people test their EAs on a $10,000 account. But as for you, I'm testing it for you on a $100 account, so you can actually see that this thing actually works. Okay, so let me just click on start. As you see, we will actually get a screen pop-up of the strategy tester with the visual mode. Right, there we go. And look at what happens. I want you to see I want you to see the EA in motion. And let me do this. Let me stop it and start it again so that you can see the first trade that it took. Okay. Let me stop it and start it again so that you can see the first trade that it took and how that trade went. I'm going to slow it down a bit. So start. Then let me slow this down. Right. So this is the 1st of July, right? And we are not sure if there's any confirmation there. There is no confirmation. So the trade is, the EA is not trading. There's no confirmation. And it's not trading against the spikes. It just trades for the spikes, like there. You see, after the confirmation, the EA actually goes into profit, and then you see the stop loss there moving. Let's see what happens to the stop loss as the market actually goes up. Right, you see the stop loss was actually following the market. And so let me just fast forward this so that at least I don't get, I don't make too much, I don't make too much noise or take too much time for you guys. Right, so this is the test, and some of these trades you actually hold them for quite a while. Okay, I've created the EA so that it spots very good entries. Okay, so even if the market goes against you for a short time, it will actually come back up. Right, so this is the EA, and let's see what the graph actually is looking like. The graph of the growth of this EA. So look at that. This is from July 2021, the 1st, and then we're moving to the 13th, and we're already on about $200, right? And we are at the beginning of July, right? Let me show you this as well. So I optimized these EAs. I optimize these EAs such that at least if, depending on your style of trading, if you want a very small drawdown or you want the loss, maximum loss that you're willing to take on a trade to be very, very low, these are the inputs that you put there: the take profit, the stop loss, and the trailing stop. And you get a profit of about 440 over the 2 months from July. Let's see. It's still on the 23rd of July, 25th of July, and it's still going up, still going strong. And if you're a little bit conservative and you want probably a higher stop loss, a higher take profit, sorry, and more risk as well, a little bit more risk, but still on the conservative side, these are the inputs, and you can actually get a profit of $501 over the 2 months. In fact, the 1.5 months that we're testing is July to mid-August. Okay. Then for the aggressive side, probably want a bigger take profit, you want a bigger stop loss. These are the optimized figures as well. So I've got all the EAs for the different assets. Let's see. Okay, so I've got an EA that trades the boom 1000, an EA that trades the crash 1000, an EA that trades the crash 500 and the boom 500. All of these, I'm selling them separately, and they work for a $100 account separately. Okay, so the reason why I had to separate them is because it's not every time that you want to have trades happening from different directions or from different EAs and stuff, because at the end of the day, probably your account is not too big of an account. If you want all of them to be operating on an account, probably deposit $500 to be safe. Okay, and the good thing about this is you won't get wiped while you don't know, because it's, you're not trading against the spike. So the loss value, you can actually monitor it, and you have a stop loss and you've got a trailing stop that's actually following. So the market has got breathing space as well. So here is the back test, and that's 100% history quality, and with an initial deposit of $100, your total net profit is 442 on this particular account. And if you check the profitable number of trades, there is 81% of the total number of trades, and the maximum equity drawdown was $36, which means the maximum you were ever down for is $36, which is very good statistics. And the maximum number of consecutive losses for this particular EA is 2. I mean, you have to admit this is a very, very efficient EA. So guys, that is basically it on the EA. And one of the last things that I wanted to talk about was how to get phone notifications on your MetaTrader. Okay, so what you would need to do is you need to get a MetaQuotes ID, and you would need to set up your MetaTrader application on the phone so that it actually gives you notifications. And then there's another method which can take you straight to texts into your phone. It will cost you some bit of money, but I think it's definitely worth it. Some bit of money as in text charges. Okay, so charges for text messages. So I'm going to upload a video soon about the phone notifications. I realized that I don't want to make this video too long, so that I don't lose some of you here. But what I'm going to do is I'm going to make sure I upload a video pretty soon that gives the two methods and how you can actually do them, so that you don't miss when your trade is in profit or your trade is in loss. Make sure you like, subscribe, comment down below what you learned. And, you know, if you do realize liking and subscribing makes the video actually be suggested more to other people as well. So if you've got a friend whom you really want to be profitable trading a boom and crash, you can just share with them this video. If you want to purchase the EAs that I've put in this video, which are the, let me just show you, which are the Boom 1000 Assassin EA. I've got also the Boom 500 Assassin, and I've got the Crash 500 Assassin, and the Crash 1000 Assassin. Okay, so these are, I've finalized them. The ones that you see here that say V1 are actually the final versions of these EAs. Okay, so feel free, get in touch. And also I've got other products as well that are on the market. They're on this channel as well, and on MQL5 you can find them by their names. If you go to the market on MQL5, there's the ease order MT5, multiple trade closer, and the ease order for MT4 as well. So please do share this video as much as you can. Have a great one, and always remember to stay safe and never stop believing.